Welcome to the Daily Update. This is being prepared Wednesday, June 1st, where we'll look at the action in the market today and then see how things look for Thursday, June 2nd. And we had another down day. We've had two down days back to back. Is that really changing things? Well, from what I see, yeah, things are looking a little more negative, but our indicators continue to improve anyway. So I'm kind of going with the scenario right now. Are we just wearing off that short-term overbought condition before we get set to go higher? Now, we could continue to go down from here and the whole situation could change and our scenario would switch back to negative, but we still see a lot of clues and signals that suggest that we still have a chance of going higher. And I'll show you that as I go through the video. So let's go back and talk about what happened on Wednesday. Right at the open, it was a pretty quiet open, pretty much sideways. We just kind of drifted for a little while. Then about 30 minutes in, we saw selling after the release of the ISM Manufacturing Index. That doesn't come out earlier like a lot of economic reports. That came out at 10 a.m. The report ended up being higher than expected, and the markets didn't really like that, or they used that as an excuse to take prices lower. Prices fell to S1, which was at 41.02. It stayed there for a little bit, trying to build up a little bit of a base, but that didn't happen, and we ended up falling even more. As the day went on, prices fell to almost S2 at 40.72 before climbing back above S1, and we almost got to the unchanged level. It looked like maybe things were going to turn more positive. Well, that didn't really happen. Going into the close, we saw more selling, which took prices back down to S1. So we bounced around quite a bit. We ended up being down 0.75%. Volume was back to being below average. We saw that huge spike on Tuesday. Well, today we're back to what we've been seeing lately. The technicals are still negative overall, but they are trying to improve. And even with the last 2 days, we're not seeing a lot of disintegration yet. Yeah, we're seeing some weaken a little bit, but I'll go through some charts and show that to you. The market is fixated on inflation, interest rates, which is producing growth concerns. We have all the different geopolitical things going on around the world, and then earnings as they are released. Some comments that we can make are that we closed near yesterday's low. The small caps were down a little less than the S&P 500. Now, that's something I usually don't bring up, but we're watching one of our possible positive scenario indications where we're looking closely at small caps. And even though they were down, they weren't down as much as the S&P, but that really didn't help our chart spike up. Also, some comments were made from JP Morgan Chase's CEO, and he's warning about an approaching economic hurricane. And that's a pretty influential outfit, so the market didn't really like that all that much. The question I'm asking is, are we working off the short-term overbought condition? We're still a little bit overbought, believe it or not, with some of our indicators. And are we getting set to go higher after we've worn that off? Gas is still spiking. It was high yesterday. It was high again today. Fear is no longer extreme. We're still fearful, but we've ticked up just a little bit there. The S&P is still in correction territory. Our technical indicators are holding up, with some actually still showing improvement. The economic reports that came out, as I mentioned before, the ISM Manufacturing Index, it increased to 56.1. They expected it to be at 54.9. That was much higher than expected. Last time it was at 55.4, so we're seeing that tick up. Anytime we see a reading above 50, that shows that the economy is expanding. If we drop below 50, then the economy is contracting. Construction spending also came out, and it increased 0.2% on a month-over-month basis. They expected it to be up a lot more, at 0.6%. But if you look at this on a year-over-year basis, we're up 12.3%. The job openings decreased to 11.4 million. They expected it to be more. That's still an awful lot of jobs that are not being filled right now. The IHS Market Manufacturing PMI, it fell to 57 from 57.5, which we received not long ago in the preliminary reading. The weekly mortgage index that we get, it fell 2.3% after falling 1.2% last week. So we're seeing housing prices really going up, but the ability to get mortgages really going down as interest rates go up. As far as our trend, it's still negative and it's weakening, and we're starting to cross positive. The bias, I've switched back over to being more mixed to slightly negative because we had 2 down days in a row. And our momentum, I've switched back to looking more mixed overall. We just don't really know what's going to happen. I'm just running with the scenario that we could be going higher from here based on what I'm seeing in the charts, but we're not seeing a follow through with that based on price. Let's go back and look at the day's session. Sentiment, we are now at 26. We've just ticked slightly out of extreme fear territory. And over here on this side just shows how we're finally coming back up. Just to remind you, we did have another sentiment gauge that I talked about in yesterday's video where that's already gone more back to neutral. But we use this on a day in and day out basis. I use that other one only when I can get that graphic. So I tend to rely on this one more. The VIX actually declined a little bit, both on a closing basis, and we're dropping below the other moving average, and we close near the low on the bar chart. And the VIX of the VIX is really showing a decrease right now, both with the bar and on the line chart, which just measures the close. The ULCR index is going right back down to the moving average. So this is showing not an awful lot of fear in the market, and here's the longer term look at that chart. The equity put call ratio actually went up a little bit, but if you look at our 5-day, it's still declining. Still kind of high, but is going down. We did get the RIDEX bear bull ratio, and that really spiked up. This could be positive. Now, we could still go higher from here, but you're seeing an awful lot of fear in this latest reading. One thing that came out, this is a daily chart of the economic policy uncertainty for the whole U.S., and it's really coming down. This is just going from day to day, where this is a monthly chart, and we're still increasing overall. Another thing that I found at IsabelNet is that the PMIs, which came out, continue to head lower, which will drive equity or stock prices toward our lower target this summer. The manufacturing PMI on a year-over-year basis has been declining. Well, if you look at the S&P on a year-over-year basis, according to this chart, it's also been declining as well. And you can see there's a pretty strong correlation between what the S&P does and what the PMI does. According to this, they still see further declines in the S&P, which based on this number here, it looks like their target is 3,600. Here's another chart, which can be really hard to read, but really the thing to take from this is all the different QE or quantitative easing that took place. And it started back in the financial crisis with QE 1, 2, and then here they kind of slugged off for a little bit. Then we went to QE 3. Then Europe went through its whole QE process. They don't have when Japan did this back in the 90s. And then this is when we started to see the balance sheet coming down. And now we're still in the middle of QE 4 with the tapering beginning to happen. But this just shows the black line is the Fed balance sheet. And I usually show that in Monday's video because I get the weekly update for that. The blue line here is just times when significant moves have happened in the S&P. And we're seeing that happening right now. You might just want to pause and look at this. Just some different events happened. It's a little bit hard to really take a lot of conclusions away from this. But basically the idea is when the Fed is doing QE, that has a tendency for the market to go up. When it stops or they start doing tapering, we tend to see the market going down. Is that going to feed into a declining market going forward from here? Another thing is the mortgage rates versus house price growth, and I mentioned that earlier. This blue line is the S&P Case-Shiller Home Price Index, which we received yesterday. That's really going up. That's what people are paying. The black line is showing the 30-year fixed mortgage rate, and how that has really been declining. And they actually lag this by about 1 year. So it's just showing how housing prices are going up. Mortgage rates have been really coming down, but they're starting to go back up. Looking at some inflation information, gas is still, we're up over $4 now. And that, of course, is going to feed through into the pump. Heating oil is also, it's not back to where it was, but it's still spiking up. Of course, it's the summer months, so people think, well, I don't need to stay warm in the summer. I'm already warm. But prices are still spiking up anyway. Here's the inflation index, which just shows in green where we're bouncing back up with the green line. And the deflation index is also going up as well. The Citi U.S. Economic Surprise Index, this is when an economic report comes out. If it was stronger than expected, in line with what they expected, or weaker than expected. First, it went way down during the COVID plunge, and then it really spiked up. Well, what we've been seeing lately is a real lessening, where a lot of the economic reports are coming out weaker than expected. And we've been seeing that. I've been talking about that in the daily videos, and that's giving rise to this scenario that maybe inflation has topped out. Looking at valuation, the earnings revision breadth has fallen to near zero. Basically, what's happening is the S&P index, and these are earnings revisions. When this is going up, that means the companies are saying, we're making more money than we said we were going to. When this is coming down, that means, we're not going to do quite as good as we thought we were going to. And it's getting right down to the point where it's at zero. And if it falls below zero, that means, well, instead of making money, we might be losing money now. Or taken all together, a lot of companies are really lowering their earnings forecasts. Looking at our sectors, we had a lot of them down over 1%. We only had one sector that ended up being up, and that was energy, and it was up 1.63%. So looking at this, energy is still way in the lead, up over 51% since the all-time high, where in last place we have consumer discretionary. It had been down into the 30s, and then it's recuperating a little bit lately. Well, we're still down 26.73% from the all-time high. Communication, tech, real estate, financials, and industrials are all down in double digits, with communication being down almost 24%. Technical alerts, some positive, some negative. We had a BPI in the tech sector. That could be good. The NASDAQ, at first, it was able to get above 12.2, then 12.1, then it crossed below 12,000 as things turned more negative. The S&P dropped below 4,100. Oil went above 115. Looking at our intraday chart, we had kind of a sleepy open. We just kind of went sideways for a little while, and then boom, right at about 10 a.m., this is when we saw prices fall below the pivot, and we ended up coming all the way down to S1. We tried to build a support level here that maybe we could have bounced out of. No, we ended up coming down almost to S2. That was the support level that we found, and then we came back up. Almost got back to the unchanged level. Right at the end, we saw, which was probably a sell program, come in and take prices back down to just about S1. We were looking a little bit better until right at the end. Looking on the daily chart, we're coming back down to the pivot. We still have this long-term support below where we're at right now, and we're still slightly above the pivot right now. So both of those could act as support. Looking down below, you can see where volume really dropped off. We're down 14.5% from the all-time high. Looking at our technical overview, the things that are positive, they just remain the same as what we've been seeing before. Nothing has changed there yet. And then we have a whole list of our negative things right now. And some of these are showing improvement, but overall, these are all negative. Our trend analysis, this is what we're seeing right now. The green and the red, it might be a little hard to see, but they're just trying to cross as the ADX is coming down, but it's still above 20. So that suggests that we're in a trend, but it looks like a weakening trend, and it could be turning into a positive trend. The Arun was flat from yesterday's reading. A decrease in selling pressure, but also a decrease in buying power. When you compare the two, we had a flat reading. Looking at breadth, we're still seeing that positive divergence based on price. We did see a decrease based on price and volume. Here's another chart just showing a little bit further back where we saw a bullish divergence, where prices had made a lower low, but the advanced decline line made a higher low, and then we saw a nice run up after that. Then we had the March run up where prices did not make a lower low, and they did make a lower low with the bearish divergence, but we still saw a really nice run up. But then I say here, did the exhaustion happen because there just wasn't the fuel to keep it going? And that could be it. What we're looking at right now is way over on the right-hand side, the bullish divergence compared to the price action of the S&P. Our advanced decline ratio is still positive even though it is declining. New highs, new lows, rolling over a little bit with the 5 period, starting to roll over a little more with the 10. Accumulation distribution, yeah, we're seeing some weakness, but we're still above a rising moving average. Looking at those stocks that are above their 200-day moving average, I pointed this out yesterday, and nothing really new to show here. Really, the premise that I was saying is we didn't really hit an extreme reading for this right here to be a significant bottom compared to other times. But we have been down to this level before and then saw a nice run up after that. The 10-day average of the highs and lows coming up a little bit after giving us a pretty extreme negative reading. Looking at some short-term charts, I finally have a moving average chart to show. We're above the 20 period. I plot both the simple moving average and the exponential moving average. The rate of change based on 5 periods is still extreme positive. Our rainbow, we're trying to come back up into some of the shorter-term moving averages. Can't really show you the intermediate or long-term chart because the moving averages are still far, far away. The McClellan oscillator, it worked off that extreme positive reading. The force index declined a little bit, but is still positive. Stochc RSI coming off an extreme positive reading, as is the Williams %R. 20 periods had been extreme, working that off, 50 declining and the 200 declining. Stochastics not quite out of extreme positive territory on the short term, turning over a little bit with the intermediate term and still showing some improvement in the longer term. Looking at some intermediate term charts, all of our oscillators are still hanging in there. They're still pointed up. The vortex, it's looking more positive. We did have a cross, and the green line is starting to come back up to 1 as the red line continues to decline. The Swinland trading oscillator coming down a bit after giving us almost an extreme positive reading based on price and volume. So this is part of working off the short-term overbought condition that we've been seeing. The BPI, it just ticked up a little bit more. The PMO continues to be positive overall, where based on price and volume is still advancing. The PMOs that are rising, yeah, it's coming down and not quite out of extreme positive territory yet. Same thing with the buy signals, starting to roll over a bit, where the PMOs that are above 0, it was flat, but still tending to go up overall. The summation index is still going higher, but based on price is below 0, where based on volume, we also advanced, but are above 0. The CCI just starting to come down out of extreme positive territory. The ease of movement still continues to advance. The boom indicator is pretty much more back to neutral on the 50 period as well as the 200. Volume intensity, we saw a real decline because we saw that volume spike on Tuesday. Well, we're back down to below average. So now we're seeing a much lower reading, and we'll probably get back below the moving average if we continue to see below average volume. Chaikin oscillator turning down a bit. Chaikin money flow also declining, and the moving average is flattening out right now. The money flow index continues to show a little bit of improvement. TTM squeeze also showing some improvement, and the longer term chart. The chart variations, Heikin Ashi still looking okay. Hasn't seen enough of a decline yet to turn the candles black. The Kegi still remains positive. The Renko hasn't really changed yet, but it hasn't gone negative either or taken that clear box away. 3-line break also has been holding up. Our different trading systems, the Elder Impulse continues to be positive for the S&P as for the SPY. Our SAR, the dots are underneath, so that continues to be positive as well. Our go, no-go is still more in neutral territory. Long-term chart below the 200-day moving average. Our moving average study coming back down on the 50, 150, and 200. Special case, still trying to turn up. Fibonacci retracement. This might be some of the trouble that we're running into. We're bumping into this Fibonacci retracement level here, and we need some strong power and some strong convincing to be able to break through above that level. Broad market based on diamonds is still positive, and the Qs are still positive. The Vixen is also seeing a bit of a decline on the bar chart, as well as a little bit of a decline on the line chart. Looking at the dollar, it rebounded a bit, so the uptrend is still intact, and this is what we're watching for. We had a spike in the dollar, and so are we going to see continued weakness, or is the dollar going to be able to rebound and start going back up? Oil is at 115.26, not as high as it had been, but still is very, very high. Gold is still flirting around with the 200-day moving average. It's a little bit above it now on the gold ETF. Here's the longer term view. The silver ETF, we're seeing a death cross. So this is looking more negative, even though it was up almost 1.5%. And here's the longer term look. We're seeing a series of lower lows here on a closing basis. The correlation between oil and the S&P still continues to be very high. That means they're going in the same general direction with each other. Looking at bonds, the World Bond Index did decline based on price. And here's the total bond ETF. It was also down where we came back up to the 50-period moving average. Maybe that's acting as resistance right now. The high leverage loans were up slightly. Just want to keep an eye on this right now. If we see real economic problems more than what we're already seeing, it would tend to reason that this ETF would really start to go down. Treasury yields went back up on Wednesday, but on the 3-month, they actually declined. Our possible positive scenarios, the Copic curve is still giving us a signal that still seems legitimate. The 2-year spike, we're wondering. It does look like it spiked a little bit here, but we were up with the 2-year yield. Mass index also having just generated a signal. The Pring bottom fisher is still suggesting that maybe we've bottomed out and could be going higher. Small caps, it's not really spiking up the way we would like to see that. This is still looking viable here, and this is a longer term where the small cap spike, that's more shorter term. If you go back and look at what happened with the S&P and also with the 2-year treasury spike, this seems to be more substantial. When the staples, the things that you have to have, those start going down, that means the economy is doing better and people can buy things they want to buy instead of only the things they have to buy. And then we do a ratio between the staples and the S&P. That has been declining overall, and this could mark some kind of a bottom. We're just not seeing follow through yet based on price. Now, if we really start to tank on price, this could really start to go back up and possibly remove this spike that we're seeing right now. So what's our outlook then for Thursday? The technicals are turning positive, and I'm still going with the idea that we're working off the short-term overbought condition. Sentiment still remains very negative. We're not in extreme fear, but we're still on the very edge between fear and extreme fear. Growth and value, the battle goes back and forth. Economic reports, the ADP employment change, will be coming out. That usually comes out right before we get the big jobs number. We have the weekly jobless claims. Then we have the revised productivity and unit labor costs. That'll be coming out. And factory orders. A lot of these taken together might tell us a little bit of a story, but the big number is going to be on Friday with the employment situation report. Of course, all of the geopolitical events, Russia, Ukraine, China and the supply chain, inflation, interest rates, growth concerns, oil, earnings, Fed speak. Looks like we're not really getting the Fed policy shift that we thought we might be getting. So now we just have to keep watching things to see if something else comes out. If anything, they're walking back the idea that they're not all that willing to pause with interest rates. And the market's just kind of waiting to see what will the Fed say next. And then we're keeping an eye on the longer term scenario in Japan. And I don't go through and explain that on the daily charts because I'm still doing some research on that. And I might even do a supplemental video about that at some point. But I'm just watching things right now. So our scenarios are Rising interest rates, inflation fears, all the things that I just mentioned, as well as selling into strength, those could turn the market down. The technicals are still negative, but they're trying to turn more positive. What could help us go up from here? The technicals are looking a lot better, and sentiment is still pretty extreme. You got a lot of people that aren't believing, the market's not going to go up from here. Sometimes that's when the market really surprises folks. The possible positive scenarios, and that's kind of hard to say sometimes. The Copic curve, the Pring bottom fissure, they've turned up. The staple spike, that's probably our most viable signal right now. We've also had a signal triggered with the mass index. And the 2-year yields, have they topped? No, it doesn't look like they really have, and we haven't really seen much of a Fed pivot to this point. The technicals, including the pivots, short-term moving averages, fib retracements, and previous levels may provide either support or resistance, and no, we're not in a sideways trend currently. So what is our conclusion? We're still negative, but could be turning positive. We're still in that woulda, coulda, should be thing. Short term, turning back more positive, but we're still looking at some overbought indications, but we've worn off a lot of those. Intermediate term, negative, but could be turning back to more positive. Long term, we're still negative. So thank you. Have a wonderful Thursday. I'll prepare the next video after Friday's session. Sometimes I'm a little bit late with that one, so bear with me. And I'm just trying to drag out the time a little bit now so that the end cards can be put later on in the video and not overwrite some of the things that I say in the video. And I hope you didn't hear any of the chainsaw in the background as I was recording that. So have a really good day.